Welcome to our regular 6-minute strategy from me, Guy Monson. Global equities have risen sharply since Trump's Liberation Day on April 2nd, fueled by earnings that as yet appear unaffected by the president's tariff agenda. Global profits are forecast to rise by around 13% for the year ahead, with dividend growth set to top a robust 10%. US share buybacks have been running at near record levels too. The rally's leaders have been cyclicals, including industrials, banks and other high beta favourites of US retail investors. Quality stocks with their high return on equity, steady earnings and sturdier balance sheets have trailed. That's been uncomfortable for our thematic and quality tilt, but we think it remains right for longer term investors. 3 reasons stand out. First, the US economy is undoubtedly cooling as employment data slows. Second, tariffs are starting to sting with price survey data rising. Third, valuations are frothy, stoked by retail speculation and record margin debt. As we'll see in the slides ahead, this is not the time to cut equity exposure overall, with fundamentals still so strong, but it is time to insist on quality. At this point in the cycle, resilience is worth paying for. So before we look at equity markets, let's consider some other assets that have been moving strongly in the markets over the last few weeks. Well, obviously the leader is gold, opening this morning over $4,000 an ounce, an all-time high. Now what's been driving that? Well, the dollar's been weak earlier in the year, and that always supports precious metals. On the right-hand chart, though, you can see the really big new factor, which is consistent central bank buying, with gold now representing 14.5% of central bank reserves, higher even than the euro. That red line, a lot of it's come at the expense of reducing holdings in US treasuries. Our third factor that's come into this has been the retail investor, who now seems to be buying as well, with ETF demand rising. We're holding our positions for now, seeing this as a long-term strategic shift by central banks and other investors. Let's return now to the equity markets. You can see there on the left-hand side that steady rise upwards, really, with equities climbing consistently since Trump's liberation speech back in April. What you note there is also a divergence from quality, and the quality names which had led have sharply underperformed. This has been a cyclical, financials-led rally with a lot of low-quality, unprofitable technology added in by retail investors as well. And we think that quality can come back, and as you can see on the right-hand side, the relative PE ratio of the quality index over the main index is back now below the 10-year average. In other words, quality is cheap. Why else would we be interested in quality? Well, a lot of it comes from the structure of turnover now in the US equity market. And you can see that a long-only fundamentals like our investors like ourselves only represent now about 12% of total turnover. We are dominated by retail investors in grey and high-frequency investors in the dark grey at the bottom of the pie. In other words, it takes time for those long-term fundamental investors to see their vision of the world turn up in equity turnover. So yes, we've got to hold our nerve. These retail investors might keep buying these low-quality names for a while longer, but ultimately that quality position will come through. I think an additional factor which supports earnings quality in particular is the position of the US economy. Now, without doubt, the US economy is slowing. You can see in the left-hand panel that those job openings are now below the unemployed number of workers in America, and that labour market generally softening. It's also, we're seeing it in the forward-looking surveys, the famous ISM Services Index, on the brink of contraction. Anything below 50, that blue line, will be contraction. But what really worries me is at the same time as that economic slowdown, we're also seeing a sharp increase in inflation expectations, with prices paid surveys showing really some powerful pricing pressure coming down the pipeline. I'm afraid that's likely to be tariffs that will impact prices, but just the timing has been longer than we anticipated. Beneath all of this, though, the equity fundamentals are attractive around the world. That's clear to me. For the first reason on the left, you can see that earnings forecasts for 1 year ahead at 13.8%. That's a very robust number, higher even than before Trump announced his overall tariff program. On the right-hand side, you'll see world dividend growth, a very robust 11%, and those US share buybacks just continue to power in. So it's a core support of the equity market, a core overweight, but with an emphasis on quality. So what's this mean in terms of overall policy? Well, first of all, I think we continue to underweight bonds. Credit spreads are very tight. Government yields are attractive as the yield curve is steepened, but not attractive enough yet. I think we need to say, for example, here in the UK, the 10-year gilt to move somewhere through 5% to trigger some serious buying from our managers. In equities, we remain overweight for all those reasons, buybacks and dividend growth very strong, but with a heavy quality overlay to guard ourselves against a setback in those retail investor numbers. Alternatives neutral, but a big overweight in gold. Again, we think this will continue to be accumulated by central banks and increasingly emerging world domestic investors. Cash remains an underweight. Within that policy, what's keeping me up at night before we close? Well, I'm a little bit worried about stagflation, these rising inflationary numbers that appear to be very sticky, set against a genuine slowdown in the US and potentially European economies. Secondly, climate risks worry me, a particular year, I'm afraid, for record-breaking climate numbers, which puts long-term pressure on industrials, particularly in Europe. And finally, valuations are high. But set against that, with a quality overlay, buy equities, hold equities. Those with strong resilience will come through as the months progress into 2026.